on today's Closing Bell Exchange. Stephen Wood from Russell Investments, Lee Munson from Portfolio Asset Management, and our very own Rick Santelli. Gordon Charloff as well, a CNBC market analyst from Rosenblatt Securities, is going to join us in just a minute. Stephen Wood, I'll start with you. You're sitting right next to me. What do you make of the move? I mean, we're sitting at 5-year highs yet again.
I think you've got a recovering economy in the United States. Europe is pulled back from the headlines, at least for the last couple of months, and China's really begun to show a soft landing. So the global economy is doing much better than we would have thought 6 months ago, certainly 4 years ago, and I think the markets are pricing that in. So the fundamentals in the economy are improving gradually, but they are improving, and corporate America looks in very healthy shape.
I wonder, Lee Munson, if it's actually a reaction to fundamentals here. Lee, because, I mean, we know that there's a ton of money swashing around on the sidelines from corporates as well as the Federal Reserve, making this interest rate environment so attractive and really few alternatives. So is it really a function of the global economy, or is it more a function of this money that needs to find a place to go, and U.S. equities seems to be the best looking game in town?
Well, you know, I do think it's a little bit of the latter. When you start looking at the velocity of money, I'm not trying to get too into the financial jargon, but we do have an issue where we still have people seeking out safe money. However, if you look at the growth of bank lending, commercial bank lending, or what we call credit growth, it's above 6% right now. So we do have banking and financial organizations wanting to lend money, and as they do that, that's going to create the capital to give those fundamentals that we've sort of forgotten about. But there's no denying that when the Federal Reserve is printing $85 billion a month, it's going to have an effect. But keep in mind, we still are looking at maybe 8-10% S&P corporate earnings growth. Now, let's not get an argument about top-line growth.
Wait. You're talking about the fourth quarter, 8 to 10% in the fourth quarter?
Oh no, I'm talking about estimates for 2013. Forget the fourth quarter. It's too confusing for me. I got the Hurricane Sandy, and analysts who didn't have their act together. I think this year we see 8 to 10% earnings growth, even with the fiscal drag, which I think is blown way out of proportion.
Because S&P Capital IQ is looking for 3% growth in the fourth quarter. So you're talking about the year, Scott.
Yeah.
No, I'm talking about 2013.
Right.
I totally agree with those estimates. We're gonna get killed fourth quarter, but it's in the past. Forget it. Let's move forward.
Hey, Rick, I'm going to ask you a loaded question, but I want your expertise on it anyway. Is there a bubble in the bond market?
No. Prices are lofty, but to me, a bubble implies a very close to popping scenario. You talk about bubbles when you think it's about ready to burst. It's frothy, but it's frothy actually in a somewhat sane way, ironic but sane, and just take the discussion we're having right now. The ECB tries to talk recovery, and just because things like the DAX and the CACs are up, everything rosy in Europe, look at their unemployment rates. Once again, it's the same scenario as in the U.S. If all you use is a barometer against economic growth over the bigger picture, next 3 to 5 years, even the next 1 to 3 years, our stock price is really delivering you an accurate message, and you can see that everywhere. If you look today, the HYG ETF is making new 4.5-year highs. They like the high yield better than they like the investment grade. You see it in the spreads as well. And this is at a time where there's a boatload of issuance this week, maybe as high as 21 to 25 billion.
Look at the currency market too, Rick. Right, the euro dollar. I mean, the moves there off the ECB.
What?
Yes. I mean, Rick, look at the dollar index. It's down 7/8
I can't hear anybody if everybody's talking on top of everybody else.
Yeah, well, Rick, talk about the currency market. That's really telling today, too, off of the ECB stuff.
Oh, yeah, off the ECB, off the Monetary Policy Committee of the Bank of England. The pound is up dramatically. The euro is up dramatically. And even though we're still all rallying against the yen, this is one of the biggest drops net day over day in the dollar index I can remember in a while. It's getting close to a whole cent drop. That's pretty big.
Let me get to Gordon here, because, Gordon, we're seeing a real move up in this final hour. What are you seeing in terms of flow? Where's this money moving, and who's buying here?
Well, listen, you're seeing it institutional. Again, we're seeing it across all sectors. The important thing, though, Maria, is that we're starting to see it in the financials, which to me is sort of the bellwether of this thing being a real bull move here to the upside, because behind financials, you know that housing is going to be behind that, and that's going to be one of the things that we've been waiting for down here for a long time. This is an inexorable move to the upside, and we are just seeing more and more guys buying in here. The volatility is still low. The volume is just starting to pick up. But this is money that's sitting on the sideline saying, listen, I got to get in here. It doesn't really matter which sectors in a lot of ways, but the fact they're going to financials is very important.
You know what I think is interesting? The financials rallying ahead of the earnings, because we're going to get a whole slew of earnings in the financials next week. Are you seeing real conviction there, Gordon, in terms of these buyers in the financials?
You know, Maria, I am.
Or is it just a trade? You are seeing conviction?
No, it looks like it's conviction. Look, again, the fact that these guys are all buying ahead of earnings indicates that these guys are anticipating a move. They want to get in front of it. I don't think it's the guys that are looking to buy and then looking to sell on the news, sell on the earnings. I think these are guys that are seeing that this is where the play is right now. They're getting in front of it, and they're going to be there right through the move.
Yet, Stephen, you guys don't love the financials. We had your chief investment strategist on halftime today, and financials aren't one of the top sectors that you guys are looking for. You're not looking for a big repeat in what we had in 2012.
I think that's true, and it's more of a stock selection than it is a benchmark relative. So if you relative to the benchmark, we're underweight, but there are certain names that we do like. They had a very, very good run. But I think you bring up a very, very good point. If we go back, what is the Federal Reserve trying to accomplish? They are strangling us in safe haven assets. They're forcing investors up that risk curve. So what we're saying is looking at valuations ultimately matter, as in the case of financials, but globally diversified portfolio of risk assets is where a lot of people are going to have to go. Emerging markets, global credit, even in commodity space, if you got a longer time horizon, it's really kind of unavoidable for people that need to hit these investment goals.
What do you want to avoid here?
I think right now, obviously, treasuries, government, sovereign debt doesn't look terribly attractive. I think in fixed income, you got to be very, very careful to make sure that the spreads have not narrowed too much. So I think on the fixed income side, we like more global and emerging market, global credit. We do like U.S. equities. And within equity space in the United States, healthcare is something that our managers like. Energy, more cyclical, consumer discretionary, just kind of leaning a little bit into a cyclical play. Don't overshoot it, but just lean into it.
Yeah, but I mean, at the same time, you guys are only looking for 1,500 on the S&P. We're at 1,470. So
yes.
Between now and the end of the year,
30
you're only
points?
looking for 30 more points on the S&P.
Yeah, coming into this year, there's a lot of volatility that's going to be wrapped around that. We saw this last year. There's a rally, pullback, and then a rally into the end of the year. We think high single digits is a reasonable expectations for someone having this market wrapped with a lot of volatility. If you get a little bit more, so much the better. But it will be a choppy ride, in our opinion.
All right.
All right, we'll leave it there. Gentlemen, thank you so much.